Hello, and welcome to Business 110, Chapter 4. Today is all about the way you can legally begin your business. And there are 4 types, if you will, of ways to start a business. And I'm going to go over 3 of the most common, and we're going to touch on the 4th. So there's a lot of information, so I'm just going to dive right in. So the first way that you can organize your business is something called a sole proprietorship. And by far, this is the most popular for small business. This is where you own it. You and you alone own the company. So there's lots of advantages. It's easy to do. In the state of North Carolina, you just need to get in touch with the Secretary of State and fill out the forms, make sure nobody else has that business, and pay the filing fee, and you can own your own company. So it's very easy to own. The retention of control, all that means is that you can run it. You don't have to ask anybody's permission. It's your company, which kind of goes right back into pride of ownership too. You own it. You make all the decisions. This is the reason why a lot of people start companies, is because they want to feel that. They want to know that they built something up from scratch. Another possible advantage is the retention of profits, so that you don't split your money with anybody else. You own it. And there are possible tax advantages. Now, I am not a tax attorney, so I am not going to tell you all about the different ways that you can write stuff off for your business. Just know that if you own your own company and you are the sole proprietor, there are some tax advantages, and you'd have to talk to your tax accountant for all of those. There are some significant disadvantages to owning a sole proprietorship. Limited financial resources. You are the one that has to come up with all the money. It's on you. So, if you want to have $1 million company and you don't have $1 million, what do? We're going to come back to unlimited liability. Limited ability to attract and maintain talented employees. And I think we all know this just from our own experience. If you have the chance to work for a very small company that cannot promise you anything, or a large company that has all kinds of benefits and is going to be around for a while, most of us are going to choose to work for the company that's been around a while. Now, there are those people who want to work for a startup because they want to get in on the ground floor and possibly, and I emphasize possibly, make a lot of money. So there is a limited ability to attract the talent. Now, that doesn't mean you can't. So, if it's a startup and, maybe it's a tech startup, maybe there is a slight possibility to make a lot of money if you get on the ground floor. From all I've read, the number one reason sole proprietors fail is because they misjudged the amount of work it takes to run a company. I cannot tell you the number of people I have heard, I want to start my own business because I want to set my own hours. That's all good, but you don't set your own hours. Your customers set your hours. If you're not going to be open when the customers want you to be open, guess what? Your business is going to fail. So a heavy workload is one of the big reasons why companies fail. A lack of permanence. When you die, unless you've made arrangements, the company dies too. So I told you we'd come back to unlimited liability. This is very, very, very important, and I want you all to understand this. There's no firewall, if you will, between your finances and the business's finances. So let's say little old lady trips on your welcome mat coming into your store and decides to sue you. She can sue the company and you personally. She can get your car, your house, Any money you have saved in the bank, it's unlimited liability because the company and you are the same thing. Huge disadvantage. So let's move on to general partnerships. Now, there are lots of different ways to form partnerships. You will see I have limited partnerships and limited liability partnerships, and there's limited liability corporations, and people get creative with partnerships. We're not going to get into all of those fancy different types of partnerships. Know that they're out there. Your book talks about them a little bit. They're kind of a hybrid, and different states have different rules on who can and can't form a limited liability partnership. So just keep that in mind. So for partnerships, you have the ability to pool your financial resources. Two people's money is better than one person's money, right? You have the ability to share responsibilities and complementary skills. So what that means is maybe you're not so good at accounting. Well, maybe your partner is. So you're able to kind of play off of each other's strengths to make the partnership better. Like a sole proprietorship, general partnerships are easy to form. You fill out the paperwork. But I really strongly suggest if you ever go into a partnership that you have a lawyer involved because they can get kind of sticky. And again, possible tax advantages, you have to talk to your attorney about that. For the disadvantages, again, unlimited liability. Unless you form one of those fancy limited liability partnerships, if it's just a general partnership, there's no firewall between you and the company. And so when someone sues, not only can they go after the company, they can go after you. Potential for disagreements. So most partnerships fail because of this. Let's just be honest. You don't get along 100% of the time with everyone. And when you add in money, there is a potential for disagreements. And how do you get out of a partnership if you've both put up equal amounts of money? That other partner's going to have to buy you out. And if they don't have the money to buy you out, you're stuck in a partnership that you don't want to be in. So that's the difficulty in withdrawing also, is that let's say you each put up $100,000 and you're done. You've had enough fighting, you want out of this. Well, you want your $100,000 back. You're not going to just say you keep it. But what happens if that person that you're in the partnership with doesn't have it? So see, you're stuck. And again, lack of continuity. Once one of you were to die, unless you've made arrangements, the partnership itself dies. So now we're going to move on to corporations. And I know that you all have heard of corporations. So the benefits, limited liability, okay? There is a separation between a corporation and any person that has a stake in it. A lot of people like to think of corporations as their own business entity. In other words, they are their own separate person. Corporations have their own unique tax ID number. So you can be a shareholder and don't have any liability. So there's also permanence. If you're a shareholder and you own stock in a company, if you happen to die, the company still goes on. Ease of transfer of ownership. You just buy stock. You don't have to, dissolve it if somebody dies. You have the ability to raise capital and the ability to use specialized management. In other words, you don't have to rely on the people that own the company to run the company. Now, there's significant disadvantages to corporations also. They're expensive and complex to form. I've never heard of someone starting a corporation without having a lawyer involved. I'm sure that if you were super smart, you could do it, but I've never heard of it. Complications when operating in more than one state. Anybody know what the minimum wage is in California? How about Utah? It changes from state to state, right? So if you're a corporation and you have to, or you are operating in more than one state, you have to know the laws for all of these states. Imagine if you were just a sole proprietor. How would you keep up with all the changing laws in all the states you operate in? So it's complicated. That's why you typically have specialized management. More paperwork, regulations, and less secrecy. You have to file your SEC paperwork as a corporation. If anybody can find out anything about the corporation, because you have to file all your financial reports. There's possible conflicts of interest. This is kind of, I don't put a lot of stock in this. Yes, there can be, especially if you have people on boards of corporations that may be competitors, but I just don't think that that's a huge point. The big point, and the one thing that corporations, this is a huge negative, is double taxation. Now, what that means is corporations have to pay taxes. If you are a stockholder, then you want to get dividends. And all dividends are is the profit. After everything is said and done, the corporation will send you your share of the profit based on the number of stocks you own. So, the corporation has to pay taxes on the profit, and then they send you a dividend based on your share of the profit, and guess what? You have to pay taxes on your dividends. So the government is taxing the money as the corporation, and then when you get your dividend, it's taxing it again. So this is a phenomenon known as double taxation. Every election year that I can remember, and I'm an old lady, I have heard some politician somewhere say they're going to get away with, or they're going to do away with double taxation. Never happens, but it is a huge disadvantage. There are C and S corporations. Again, some fancy different types of corporations. I just want you to know they're out there. Corporate restructuring. That's again in corporations. Mergers. That's when two corporations of the same combine. Acquisitions. One company purchases the other. And divestitures is when, let's say that you have a specific division and you don't want that division anymore, so you make it its own separate company. That's called a spin-off. So we don't do a lot in Business 110 on corporate restructuring, but I did want you to know about it. Now, the fourth type of way you can own a business, is by franchises. Two different types of franchises, and we know this, we just don't really think about it. There's the distributor type of franchise, and that's where the company makes the product and the franchisee sells it. So Randy Marion is not out here making from the bottom up however many brands they have. They don't make a Chevy truck. They sell the Chevy truck. So that's called a distributor. Business format. The franchisee makes and sells the product under strict guidelines. So the difference is, in one, you're just selling. In two, in the other one, you're making and selling. So let's talk about some of the advantages and disadvantages. One of the highest disadvantages is the cost. It's expensive. There's a lot of things that the franchisor won't let you do, but there's an advantage. It's brand recognition. Negative halo effect. I do want to talk a little bit about that. That means, let's say you had a bad experience at a McDonald's one time. You think every McDonald's around now you're going to get that same experience. So that's one of the problems with a franchisee, is called the negative halo effect. Restrictions on the sale of business. You can't just sell your franchise. The franchisor has to make that decision. So I'm running out of time. I only have 15 minutes on this particular video program, But those are the advantages and disadvantages of franchises. If you have any questions,